So, Steve, when you think about Bill Gates, right? Previously, one of the most wealthy people in the world, still is, but he was at one point the wealthiest. What
Right?
do you think of?
Computers. I mean,
Right.
God,
Founder.
it's a vague question, but no, he's a computer. He started in his garage, if I recall, and built a business, and he did pretty well with it.
Right. Founder of Microsoft.
Yeah.
And, that is the story that most people know.
Mhm.
But there's this other story that is equally interesting, which is he's also the largest private landowner in the United States. So we have a billionaire who owns more private farmland than anyone else. There's something that doesn't quite add up there to me when you think about investing. Billionaire can invest in anything they want, yet he chose to invest in dirt. What are we missing?
Not missing anything. I mean, well, take a step back. What are the two greatest wealth creators of all time have always been business and real estate. He's doing both. Now, with that said, I'll also share something else. One of my favorite phrases is wealth is created with concentration, wealth is protected with diversification. So he created his wealth with Microsoft and the tech industry. But even though he created his wealth that way, at some point he's going to want to preserve his wealth and diversify. I'm sure he has real estate. I'm sure he has other stocks. I'm sure he has probably some crypto. He's probably got a variety of different things. And that's how you diversify and protect, even though the wealth is created with Microsoft in his business. Some people may create their wealth with real estate. Some may use real estate more of just kind of a protectional hedge to diversify their wealth.
So, if I'm kind of thinking about what you just said there, a business can typically be a lot more of a active pursuit, whereas real estate is traditionally considered to be a bit more of a passive pursuit. Would you agree with that statement?
Yes and no. I mean, again, it can be, and that's the whole point. Well, think about businesses. I know people who run a business 70 hours a week. That's what they do. I also know people who own a business and they don't spend 5 minutes a week on it. And so you can own it and run it. You can own it, have someone else run it, or you can be just a completely passive, general partner or whatever. Same thing goes for real estate. I mean, there are some people, they make money in real estate. I mean, here in Indianapolis, one of our billionaires in the state of Indiana is just a couple miles down the road from me. It's the Simon family. They made their money with Simon Malls, and it's the largest mall owner in the world, and they've got them all over the U.S., actually all over the world, and they made their money in real estate. No, that was not passive. It's been they've been doing it for a couple of generations. They now own the Pacers. I mean, they're again a billionaire family, and so they made money in real estate actively. Other people can invest in real estate passively. So it's the beauty of both real estate and business. If you want to, like I said, concentrate, be really good at it, and create lots of wealth in it, you can. Or you can do it more passively, be a little bit less active, let someone else run it, and you can use it as a diversification tool there as well.
Well, that's a great point. Traditionally, if we think about what most people might assume, you could think of a typical business, one where you are in the trenches operating day to day,
Mhm.
like a race car, right? You have to keep your hands on the wheel at, 200 miles per hour or you're going to crash.
Mhm.
Meanwhile, if you look at traditional real estate where you're a passive investor, and that's almost more like a train track. Once the tracks are laid, the train moves forward on that structural momentum, essentially paying you while you're asleep. Now, in both scenarios, you can make a business, right? A business that's managed by others,
Mhm.
operate more like that train. Likewise, with real estate, you can operate it more like that car. So it really goes back to your overall strategy. Would you agree with that overall
Correct.
analogy?
Yeah, they
Okay.
can both be very versatile depending on what your needs are. Yeah.
Okay. So, when we kind of take that all together and we look at, everything from a return perspective, if we go back to that Bill Gates example,
Mhm.
you have a billionaire who can invest in whatever they want. And I understand the diversification
Mhm.
play, but
Mhm.
if we think about, Robinhood, which is in the conscious of many of your average consumers in today's environment, they're not talking about investing in real estate. So even if you're talking about, a REIT, nobody is really excited about those type of things. So, what are we missing from a return perspective? Is there some sort of hidden value there that we're not seeing?
Absolutely. I think that's, in my opinion, one of the biggest misconceptions most people have about real estate investing is that they look at it and go, well, gosh, I know some people have done well in it. Yeah, some of the wealthiest people in America made their money in real estate. And people go, well, gosh, some people have done well in it, but it's not for me. It doesn't look like it makes much money. I mean, I ran some numbers and I thought about buying this rental house. And by the time I had the mortgage payment and the insurance and the taxes and the insurance and everything is done, and I had a little bit of money set aside for maintenance and repairs, my average is only $200 a month. Why bother having a house? Okay. And so that's how some people look at it. I've also heard people look at real estate and compare it just based on appreciation. It's like, well, gosh, average appreciation for real estate in the last 10 years is a little over 4% per year. And they're like, well, gosh, I'd be better off just putting my money in the stock market. It's been averaging, 10%. Okay. But the thing is, when you add everything together, all the different benefits of real estate, hardly anything beats it. And so I'm going to kind of break that down a little bit. So because there's several pieces there. So one of them is you get to use other people's money. Okay. And I talk about this is how you create wealth. Now I'm going to give an example for my personal investing, but it's just because it's a condensed version of an example. I bought a house from the seller for $804 a month for over 5 years. And so it was paid off in 5 years. That's why I said it's kind of a condensed example. And so I paid $804. So instead of having a bank, I just borrowed the money from the guy who was selling it. Then I placed a tenant at $800 a month. So I was actually paying a net of $4 a month. Okay. The tenant, that's the beauty of real estate. The tenant is paying that debt down for you. Okay. Over 5 years, that tenant paid off that property for me and I owned it free and clear. So had I, basically I bought it for $48,000. Had I sold it for $48,000, that would have been great. Again, I put $240 into it. The rest of that was all put in by the tenant. Thing is, I also got appreciation. I didn't sell it for $48,000. I sold it for $75,000. So I put in $240 and I get back $75,000. That is the power of real estate because you're getting appreciation. Again, the value is going up every year. Just long term, that statistically, that is what happens with real estate. And you're using the tenant's payments to pay down your loan that you're getting from the lender, private lender, bank, however you want to finance your property. And so you're using leverage, other people's money, appreciation, all working together to create your wealth. But that's not it. But wait, there's more. Besides all that, you also get tax benefits. And so you're going to get depreciation. Even on a $48,000 house, that's not much, but it was still a couple $1,000s a year of tax benefit that I got on top of the cash flow, appreciation, all those other things. And so when you add all that together, it really is a pretty impressive combination. As a matter of fact, I saw an interesting analogy recently that showed a $200,000 house. And they said, someone says, gosh, I'm only making $200 a month. What a waste of time investing in real estate. And they showed this big iceberg. And of course, the 200 is above the surface, but all the other stuff is also there. A lot of people just miss it. And I'm going to give you a quick example on a $200,000 house. So you think about this. If appreciation is averaging 4% per year, which real estate has appreciated faster than that for the last 10 years, the last 20, 30, 50 years. But so 44% is a pretty conservative estimate. So if you say 4%, on a $200,000 house, that is $8,000 a year. That's about, $750 every month on average of appreciation. So your cash flow is $200, but your appreciation is $750 a month. On a $200,000 house, you're also getting, doing some quick math, $8,000 a year of depreciation deduction. Okay. So again, you start adding all those up and it's not just the cash flow, it's the cash flow and the appreciation and the tax deductions, etc. And so those are all the benefits that a lot of people just miss when they're looking at real estate and they're dismissing it as not worth my time. It's worth your time.
Well, this makes me think about real estate from two different perspectives.
Mm-hmm.
One, call it the math challenged. You threw out a bunch of different statistics there, right?
I did.
But,
Sorry.
If I'm trying to compare this to say, the S&P 500 or what the stock market traditionally grows by every year. How does that compare to, because it's almost like we would be doing an apples to oranges comparison here, but if we try to standardize it, so we're looking at the net financial benefit between the two. When you add in things like the tax benefits, the appreciation, the cash flow, how would you actually describe that for people trying to look at the value of one investment versus the other?
Great question. So I know you said math challenge, so I'm going to throw more numbers out at you then. I'll try and simplify it. So let's say you buy a house for $200,000. Okay. It's already rehabbed. Everything's in good shape. And again, I'm just using it as a nice round number. And $200,000, and you put 20% down. That's pretty typical with financing. So your investment is actually $40,000. So set that aside. You invested 40,000 of your capital. Okay. And let's just say over the next 10 years, your net is only $200 a month. And let's say it never goes up. Rent never increases for 10 years. Obviously, that'll never happen. But let's just say it did. So you're getting $200 a month for 120 months. I should have made the math easier. That's $20,000 right there. So you're getting, half the money back just in the form of that really low monthly cash flow. Okay, a $200,000 house, that's going to be basically divided over 27 and a half years. So I should have made the math easier. Let's say that your average annual tax deduction is $5,000. So depending on your tax bracket, that's going to save you another $2,000-$3,000 every year at least on your taxes. Okay, so you add that up for 10 years, that's another $20,000-$30,000 in savings right there on your tax deductions. So cash flow and tax deductions, you've already got back your money and you made some. Okay, but here's the thing. You don't get 4% appreciation on your $40,000 investment. You get 4% appreciation on the $200,000 asset. Okay, so think about that. In year one, that asset grows by 4%. So 200,000 goes to 208,000. You made $8,000 on that $200,000 house, but your investment was 40,000. You made 8,000 on a $40,000 investment. That's a 20% return. See where I'm going with that? Your gains are on the entire house, even though your investment was only 20% of the house. And so even if you just looked at that first year, 8,000 of appreciation plus 2,400 of cash flow plus what did we say, 2,000 for tax benefits, you're looking at $13,000 of benefits in that first year on your $40,000 investment. That's about a 30% return. So you want to compare that to the stock market? Cool. And if it stayed level for all 10 years, great. 30% per year for 10 years is a pretty strong return. The thing is, it compounds. It gets better every year because next year you're getting 4% appreciation on a $208,000 house. And your rent does go up, even if it stayed flat, you're still making 30% a year, but no, it goes up over time. And so by year 10, they're just crazy numbers. I mean, it is a phenomenal investment, but I'll stop there so we don't have too many numbers.
Well, you definitely put on your Professor Steve hat today, going through all the various math equations. But, really, I almost laugh thinking about me talking about that apples to oranges comparison.
Mm-hmm.
Because when you really circle back to that concept, most people aren't looking at it that way. Investing $40,000 into the stock market does not instantly give you a $200,000 asset. $40,000 in real estate using other people's money does. And I'm sure some people might try to argue, well, if you use options to amplify or, et cetera, but there's a completely different risk criteria when doing something like that comparably. And the one other thing that this makes me think of is an old McDonald's story. When you think about McDonald's, even right now, you can get a collectible cup from them, right? They oftentimes will do that over, every couple of years. This one's for the World Cup. But McDonald's, people think of burgers. But if you think about the first president, back in the 50s, when they were talking to investors about what McDonald's was in the business of, do you have any idea what they talked about?
I do, because I'm a nerd. I've studied. Yeah, it's real estate. I mean, you think about all the McDonald's, where are they located? Prime corners all over America. Prime intersections. I mean, the value of their real estate is mind-blowing. Way more than the value of their burgers.
Well, and it's funny to think about that because I think even and I'm sure I'm slightly butchering this quote, but it was something to the effect of, McDonald's sells hamburgers because that was the fastest way to be able to generate revenue. So their tenants could then pay rent back to McDonald's.
Yeah.
And so that was the whole, that's kind of the underlying hidden business totally different than what you think about McDonald's.
Right. Yeah. And one of the quotes I'd heard was very similar to that one of the CEOs at one point had said, it's like, Most people, assume we're in the burger business, and we are, but we're in the real estate business. That's our main business. Yeah, I'd heard that. But
Yeah.
I want to go back to something you said 3 minutes ago. When you were
Yeah.
comparing apples and oranges, you're talking about the real estate and the stock market, and you threw out the word risk because you mentioned options and other stuff and risk,
Sure.
accounting for risk, and that's the other part about the real estate. Can you have a stock that plummets 90% in value, or a company that just suddenly, I will even say, pulls an Enron? Oops, yeah, just it's gone. Your money's worthless. Your stock is completely gone. Yes, that can happen. If you have proper insurance and you got proper title, what are the odds that the value of a piece of real estate is going to go to zero? Pretty darn slim. And so
Right.
so that's that other part of that equation. We talk about the great cash flow and the great returns you're getting on real estate, but then you have to look at the risk reward. That reward, which outperforms the stock market, and the risk lower than the stock market, just creates a unique opportunity. And a lot of people have discovered that. And that's why so many people have created wealth with real estate. They're like, wait a minute, that's a really low risk for a really high reward. Yeah, that makes sense. I'm going to do that. So,
Yeah. There's just something funny about the simple, quote of saying, well, it's not the business owners that pay rent, right? It's the burgers that pay rent when we're talking about McDonald's.
mhm. Yeah.
But, if we kind of look at kind of wrapping this all together, the one other piece that, I think is really useful when we just think about the difference between investing in stocks versus investing in real estate, going back to other people's money. You go
hmm
to the bank and say, hey, I want to buy $100,000 worth of Microsoft shares.
hmm
What are they going to do? They're going to laugh you right out of the bank. But if you say you want to buy 100 property, they're going to be far more open to, facilitating, that sort of strategy. So when you look at being able to amplify your existing funds, it's a completely different ball game between the two. Is there anything that you'd kind of say about that?
Well, yes. Think about the bank. How are they looking at this? Okay. They're looking at this as, hey, Dave comes in and he wants to borrow $100,000 to go buy some stocks. Are we going to loan him that money? Actually, maybe. There are some criteria in a bank, and you might get a bank that would loan you as much as 50% if you're buying the right type of stocks and you give them the right type of collateral and all these different things, because they know the risk of that loan and the risk of that asset not being able to cover the loan. Now, if Dave comes in and says, hey, I want to buy a piece of real estate, and are they going to loan 50%? Yeah. 75 or 80%? Usually. There are cases where they will loan over 90%. Why would they loan so much? They've got very little protection because they understand the risk that real estate's not going anywhere. It's not going to plummet in value. And if something happened with the loan, they know the value is there in that real estate. And so thinking about it from that standpoint, the banks understand where the risk is, and they're going to make loans on the real estate because they know that if something happened on the loan repayment, they've got more protection because it's a safer investment.
Well, I'm just trying to think about it from, all the different stakeholders. You have the bank, you have, the investor, right, or the property owner. And I'm also trying to compare that to other asset classes.
Mm-hmm.
And it's often been said for those who dive deeper that real estate, has the potential to pay you in more ways than really any other type of asset class.
Mm-hmm.
And I'm trying to think even of the asset classes that have three, let alone two. Many of them just have, one, payment method that might come through it. But a lot of times people talk about real estate, you're essentially getting paid four different ways, right? That four different engines at once with that.
Mm-hmm.
And, we've kind of talked about all of them at this point, the tax advantages, the loan pay down, the appreciation, and then any sort of potential cash flow when you have a tenant. I guess when you look at that all collectively, that's also why there's that conversation that, real estate is often one of the best ways to generating assets for the middle class. But if you think about what we just talked about with those four engines, can you think of any other sort of asset classes that can do that same sort of thing simultaneously?
Honestly, no. As you were talking, I was thinking, and again, some of them it's one. I hate to say it, gold. I love gold, but you buy it at one price, and at some point, what's your option? You sell it. It doesn't pay dividends. It doesn't generate cash flow. It doesn't, all these different things. So yeah, a lot of them, it's one, maybe some of the stocks you've got appreciation and a dividend. So maybe you get two. But yeah, there's very few that have as many different ways that they create value for you as real estate does. And I'm actually going to throw in one more thing. It's just kind of a variation of what we'd already said. But you take a house now, let it appreciate for 10 years. And what a lot of people think is, okay, well, hey, I just want to get this thing paid off completely, and then I'm going to get better cash flow. My cash flow is going to jump to, $1,200 a month. Hey, that's great. But that's $1,200 of taxable income. So yes, you're getting depreciation benefits, but at that point, you're actually paying more in taxes. But what a lot of people don't realize is that most of the wealthiest people, they don't pay off the house. They borrow against it again. And so you get up to year 10 and say, hey, the house is now worth $350,000. I'm going to refinance it. I'm going to pull out $100,000 tax-free. And so, yeah, it's going to change your monthly payment. And maybe you were making $600 a month and it goes back to $200 a month. So yeah, you just cost yourself $400 a month, but you just put $100,000 tax-free into your bank account. And so that's what a lot of the wealthier people do, is that they're using their real estate to generate a little bit of cash flow. The cash flow pays the mortgage, the cash flow, covers, and maybe there's a little bit left over, but it's appreciating that entire time. And then they pull out that appreciation in tax-free chunks every 10 years or so. Well, if you get enough properties, every year, refinance one, maybe two, and that's all you need to do. If you have 20 properties and you refinanced two every year, in year 11, you're back to refinancing the first two properties again. And so you've created a perpetual, again, cash flow, not the $200 a month cash flow that most people are thinking of. I'm talking about $100,000 a year per property tax flow for two properties at a time. So it's just a different way of looking at real estate. And again, it's not an asset to grow and sell for a profit. You're better off refinancing it.
That's what is the classic way to describe it? Is it literally
refi until you die? It's a terrible phrase. Refi until you die.
I'm not sure how many people want to wear that logo on a shirt or a hat,
right,
but
right.
I'm sure those in the real estate space would get a kick out of that.
Right. Maybe I'll come up with a better phrase. Trademark it.
Exactly. It wouldn't surprise me if there's a web domain there already, refi until you die.
Probably.
But one other thing that you brought up, gold, right? Part of the idea with gold has always been, or even as some describe the modern form of gold with Bitcoin, right? That scarcity. And with real estate, the more I think about it is, they aren't making any more land, so to speak. Yes, someone can try to argue their loophole for the, the fake land that's out there. But if we talk about the traditional land, on this earth, particularly in major metro areas,
right.
I think that's part of that puzzle, is you have that built-in scarcity, which is what helps grow that appreciation.
Right.
Would you agree with that?
Absolutely. That's correct.
Okay. And so if we think that through, we've made certainly a compelling case to think about exactly why billionaires are also investing in this asset class.
Mm-hmm.
But now let's take it away from the billionaire and think about, your average W-2 employee. Maybe they have, 25 to 30K in savings. How does this apply to them when we talk about utilizing this as a strategy for wealth creation?
Well, honestly, 25 to 30K in savings is not a whole lot. If that's all they have to work with, you're probably not ready to invest in real estate. I'm just being, it has to make sense for you. Now, if you've got, 50,000 that you can invest and you got some extra in savings as a backup, okay, that's a little different. But so if you've got enough to buy real estate, then, you find a way of getting it done. You got to find the property. You have to have a rehab crew. If it's distressed property, you need a property manager. That's really the biggest part, is that property manager, because that's what's going to keep it cash flowing year after year. And so you've got to find those different pieces, put your team together. And so that's one of the things I've helped a lot of people do. And frankly, that's probably a whole nother discussion. Is, okay, we've talked so far for almost 30 minutes about why real estate. Maybe we need to have another episode on how. What are the steps and what do you need to do?
Right. I was just thinking the same thing. When you really look at it, this sounds like another podcast episode in and of itself, maybe even a series, how to do something to really take advantage of this. And, I think there's an important qualifier in there too. To your point, many a financial expert out there would recommend that you want to have a 6-month emergency fund, right? So $25,000 in savings, it'd probably be better to describe having, the requisite minimum amount in investable capital, which should
Yeah.
be separate from savings from that
Right.
perspective.
Right. So,
Yep, that makes sense. All that said, if we look at any other concluding thoughts, is there anything else you want to share today?
no, I hopefully we're able to kind of go over the reason you want to invest in real estate. And some people they've heard others invest in real estate and they say that just doesn't sound good enough. $200 a month isn't very exciting, or 4% appreciation. Well, gosh, that's boring. CD outperforms 4% sometimes. Well, no, then you're missing, again, that's the tip. You're seeing the tip of the iceberg. You're missing all the wealth that's being created down below. So hopefully we got that point across and people have a better understanding of how to use real estate to create wealth for themselves.
Makes sense. Definitely makes sense. And yeah, I go back to that same concept, we ending where we started, right? Bill
Mm-hmm.
Gates can invest in anything he wants, but at the end of the day, he chose to invest in dirt. And it's
Yeah,
certainly something to think about, for anyone as they're looking at what their next potential investment vehicle should be.
that's right.
With that, Steve, we'll stop for now. And thank you as always. And everyone have a great week.
Yep. Awesome. Thanks, Dave.